Hello, everyone, and welcome to our webinar today. My name's Sarah Campbell. I'm here with USDA. I am the Beginning Farmer and Rancher Coordinator, and our Beginning Farmer team is where our Taxpayer Education and Asset Protection Initiative is housed. So for those of you, if this is your first Farm Tax Education USDA webinar, welcome. There are a lot of other resources on really important topics, especially this time of year, such as 1099s, filing a Schedule F, how to choose a tax preparer, and you can find links to all of that information on farmers.gov/taxes. If you are joining us as somebody who regularly participates in this series, welcome back. Glad to have you. This webinar is being recorded and we will be taking questions. So please put your questions in the Q&A box during the presentation. So we'll have time to answer those throughout and at the end. The webinar, as I mentioned, is being recorded. It will be posted on our farmers.gov Farm Tax YouTube channel. The slides, everything will be available online. It just usually takes us a few weeks to do that because we go in and caption those and make sure all those materials are accessible. So with that, I'm going to hand it over to Bob Ray for this very important and timely topic. Thank you, Bob.
Hi, Sarah. Well, good afternoon, everybody. Thanks for joining us on this Rural Tax Education webinar discussing reporting sales and purchases of farm assets. We had several questions on the right forms, the right processes, the tax treatment, what information might be needed to complete the proper reporting of these on a farm taxpayer's tax return. So today we'll walk through many of those pieces. This is information that comes from not only our USDA friends, Sarah and Jan, that you see on the screen, but also through our partners at the Rural Tax Education Group. That's made up of individual members from many states across our great nation. This is part of a 3-year project, and as Sarah mentioned, we have several other materials available that have been designed and created for your consumption regarding farm tax related matters. The Rural Tax Education website is the place you can go to find many of these other pieces. These were materials that have been developed and owned by the National Farm Income Tax Extension Committee. I'm a member of that committee by virtue of my participation at the University of Illinois in Champaign-Urbana Farm Income Tax Schools. Most of the members of this committee are heavily involved in their state's farm tax related education information. So today we'll cover the Farmer's Tax Guide, what's new, that's publication 225. We'll describe the 2024 reporting rules. There's a caution about machinery sales we want to share that sometimes catches people by surprise with an unintended income tax result. We have a couple of examples to look at, and we'll finish today by looking at the primary forms 4797 and 4562 that are used to report this information and are included with an overall farm taxpayer's income tax return. The Farmer's Tax Guide is the place that we begin our study today. It's publication 225. It's updated annually, comes out in October or November of each year for information to use in that current year's tax return preparation. Several chapters are in this document, all kinds of information about income, expenses, tax deductions, depreciation, estimated tax payments, fuel tax credits, dispositions of assets. All of these types of topics are covered in this Farmer's Tax Guide. It's been around a long time. It's a very unique and valuable partnership between members of the National Farm Income Tax Extension Committee from each of these various states and the Internal Revenue Service. Each of our members on our committee have assignments that are due within a few days here to make suggestions for improving this document. We will submit those to the Internal Revenue Service. There's a meeting held in May of each year where we collaborate together with them to understand what we're writing about, to understand what their views about these are, And changes are made to this document each year based on input from each of those committee members, which really means it comes from every one of you who are participating today, because as the tax prepares, you're telling us what things make sense, need clarification, need updates. And it all works from the grassroots level through this university level, land grant university level extension committee, and then one-on-one meetings with the Internal Revenue Service to further develop this product. So here are the standard what's new items for depreciation, which is the section that we're studying today regarding purchases and sales of farm assets. So new for 2024, we have increased Section 179 expense deduction dollar limits. For 2024, that's $1,220,000. That's the amount that anyone can, the maximum amount that any taxpayer can expense on their tax return for purchases acquired during 2024. Of course, there are other restrictions and some other limitations. We'll talk about those as we work our way through today. But the first number that comes to mind with IRC 179 deductions is how much can you use? And for 2024, that's $1.22 million. We know the number for 2025, it's a little bit higher, $1.26 million. But for 2024, we're focused on 1.22. There's also a limit on the total cost of assets that can be acquired in a year for which the 179 deduction can be fully used. And that's called the placed in service limit. For 2024, that's $3,050,000. And what that means is as long as you've spent not more than $3,050,000, that full $1.22 million expense limit is available for the tax return. And again, other restrictions might reduce its full availability, but we're trying to identify the largest deductions that could be available. And that's the true number, 1.22 million, as long as not more than 3,050,000 has been placed in service. Once we exceed $3,050,000, that 1.22 million decreases dollar for dollar until we have total expenditures of those two numbers added together, which is $4.27 million. If you spend more than 4.27, there is no 179 deduction available. So as long as you're under 3,050,000, the full 1.2 is available. But as you spend more, the 170 deduction declines as it's available. There's also a special 179 limit for SUVs. That's $30,500 for 2024. The column on the right of the screen is a different type of depreciation available allowance, and it's called a special depreciation allowance, also commonly referred to as bonus depreciation. For 2024, that amount is 60% of the qualified property purchased during 2024. A few years ago, that was 100% bonus. Then it dropped to 80% in 2023, 60% for 2024, and will be 40% for purchases that are made in calendar year 2025. So 60% is the number that we're interested in for 2024. You see there's a small variance for certain property that has a long production period. They're still at 80% for that number. But for most of our farm clients, it would be extremely rare for that to occur. And we're interested then in our 60% bonus depreciation rule for 2024 purchases. This is a significant change that came from that grassroots effort to the committee on to the Internal Revenue Service, and was a very positive, helpful change adopted in the Pub 225 for the 2023 version, and it's also there in the 2024 version. And this relates to, really, it really opens the story to a lot of things we'll talk about today. because under the TCJA, the Tax Cuts and Jobs Act from 2017, that was effective January 1 of 2018, there was a big change in how we reported sales of machinery, including items of machinery that were traded in on the purchase of other equipment. Prior to 2023, we treated those net cost as sales. And prior to we treated those net cost of the acquisition as the purchase. Only the trade difference was included in the purchase. And prior to 2023, sales of machinery were not included in the definition of gross income from farming. I want to clarify what I just said. Prior to the TCJA, we only included the net trade difference in our purchase amount. And prior to 2023, consistent with that language, sales of machinery are not included in gross income from farming. And once we had to change how we reported from TCJA rules, that our trade-ins are now on Form 4797 as a sale, those large 4797 gains perhaps disqualified a taxpayer from being a farmer because those 4797 gains were not included as gross income from farming. And if I'm not a farmer, I'm not eligible to make only one estimated tax payment on January 15th of the following year. If we look at our current year for 2024, farmers had two choices. They could make an estimated tax payment on January 15th of 2025, or file by March 1st and make no estimated tax payments. And if I'm not a farmer, because of this unique change caused by the TCJA requirement, I might be subject to a penalty that I wasn't expecting. And so for the 2023 Pub 225, a significant change was made that now adds sales of machinery in the definition of gross income from farming. And that is this cut from Pub 225 that's shown on our screen. It's the last bullet point. The other 4 points stayed the same, but in 2023, we added this nice bullet point that says, gains from the sale of depreciable farm equipment reported on Form 4797 are now included as gross income from farming. And so therefore, the TCJA change in how we reported trade-ins of machinery no longer disqualify a taxpayer from being a farmer. Well, a couple of things to close this slide. This is very helpful to farmers who are really in the trade or business of farming, even though they're trading in equipment. And it's a very prime example of the grassroots effort that comes from farm tax preparers, from farm tax clients, to the land-grant universities, then to the Internal Revenue Service for a reasonable change in the rules. One more point about estimated tax payments, because this farmer rule is really critical. Plus, we're also very near one of these important dates. So for estimated tax purposes, IRS considers a taxpayer a farmer only when 2/3 of their gross income is derived from farming. And that's from the definition of those bullet points we saw on the prior screen. If they then are a farmer, they have 3 choices about when to pay their tax obligations and when to file their return. The dates listed here are for calendar year taxpayers. If you have a fiscal year taxpayer, you would just advance these dates to the appropriate numbers of months after their year end. So a farmer can choose to make one estimated tax payment on January 15th and file April 15th and not be subject to any late filing or underpayment of estimated penalties. Or their second choice is to forego estimated tax payments completely, never make quarterly or once a year payments. But if they choose that, they have to make their tax payment in full and file their tax return by March 1st of each year. If they don't choose either of those options, they still have a third option, and that's not making any estimated tax payments, making all their payments and filing on April 15th. But since they have not done either of the first two bullets, an interest penalty will apply to the tax due on that April 15th return if no estimated payments have been made. And I guess I would add to that as well, if not enough of an estimated payment was made on January 15th. So many farms now are thinking about their filing requirements to be March the 1st. Well, that's absolutely true if they have not made any estimated tax payments and seek to avoid any interest penalty by waiting until April 15th to pay. All right, let's move into the asset acquisition phase of our discussion today. What are the tax effects for farm taxpayers who make 2024 purchases of depreciable property? These are capital assets like tractors, trucks, combines, harvesters, planters, tiling, irrigation equipment, buildings. All of these things are qualifying 2024 purchases that have choices available on how the deductions can be calculated on their 2024 tax return. The first option is the IRC 179 expense election. That's the amount we initially discussed that has a limit of $1.22 million, as long as expenses have not exceeded $3,050,000. This is true for new or used equipment, and we make this decision first. Then we decide if we're going to take any bonus depreciation, or more specifically stated as the special allowance for depreciation. For 2024, the decision is to take none of that or to use it at a 60% level. And for the 179 deduction, we can use sort of any dollar amount we choose, but for bonus, it's none of it or 60% of the purchase price. Whatever is not selected for 179 or bonus moves to our regular depreciation deduction schedule. We'll work through those in our examples, but these are the three steps, and they're made in this order. I make my 179 election first, make that decision. I then can choose bonus if I like, maybe none, and whatever's left goes on a regular depreciation schedule. I live in Illinois, and Illinois doesn't follow all of these rules. For example, in Illinois, we can use the full 179 expense as we do on the federal return, but we can never claim any bonus depreciation. And so we have an Illinois depreciation schedule that's different than our federal schedule. And of course, that changes from year to year, and we get different answers from an asset purchase on whether we're thinking about the federal effect or the Illinois effect. The other piece that's unique to this study is what I'd earlier mentioned from the Tax Cuts and Jobs Act. After 2017, there are no personal property like-kind exchanges, meaning even though we're doing a trade, as the farmer thinks about that activity with the dealership, there is no trade for IRS federal purposes about like-kind exchanges. We report this trade-in as a sale and report the full purchase price as an acquisition. So for 2024, a little more details about the depreciation provisions. We had 100% bonus through 2022. We have 60% in 2024 and 40% after 2024. The bonus triggers are measured on a calendar year basis. So even though I might have a fiscal year that ends January 31st of 2025, any purchases made in January of 2025 for that entity are subject to only a 40% allowance for bonus depreciation. For bonus, we have a large descriptor of assets. 20-year property and lower is eligible. So a farm machine shed is eligible for this 60% bonus deduction in 2024. New and used assets are eligible for bonus depreciation deductions. And we have to again choose 60% or none. It's kind of lumpy on how we calculate bonus depreciation for our clients. It is lumpy also by class. So I make this decision on a 3-year property. I can make a different decision on 5-year property. I can go back to bonus for 7-year property. I would probably most likely take bonus on 20-year property. I might not take bonus on 10-year property, but you have a class by class decision choice to make. But within that class, it's everything at 60% or none of it at 60%. The 179 deductions we briefly mentioned before, the maximum 1.22 million and the $3,050,000 level. Most farm assets qualify, but 20-year property does not qualify for the 179 deduction. I can use a machine shed under bonus. I can't use a machine shed under the 179 deduction. New and used, both available for this provision as well. If I'm acquiring things from a related party, they don't qualify for either bonus or the 179 deduction. But look at this unique rule. For these two provisions, brothers are not deemed to be related parties. So I can buy a truck from my brother and I can use 179 deductions on that asset. I can use bonus deductions on that asset. Very unique that IRS specifically carved brothers out of this related party definition. To get the deduction, the assets have to be placed in service in 2024. Well, they have to be paid for too. They can be paid for with, a bank loan, funded by a bank loan, but the asset has to be paid for. But we most often get questions about place in service and what does that mean? This is the definition that I like that IRS has provided. It's in a state of readiness for its intended use. Generally, that's going to mean that the machine shed needs to be constructed by December 31st, 2024. It needs to, the equipment needs to be available for its intended use. If it's not yet built, that's not going to qualify in the IRS view. If it's built and it's available, it just happens to be still in my brother's farm, which is next door. Well, it's still in a state of readiness for its intended use. And if it's a harvester and December is not harvest season, that's okay too. As long as the harvester is ready for its intended use, it will qualify for a depreciation deduction. My friend Brad Zwilling created this chart. It's a very unique look at where bonus deductions have been. Before 2002, we didn't have bonus deductions. And you can see for 2003, we had a mix. We had different amounts for different parts of the year. Then we had 50% in 2024, none for a few more years. After the housing crisis, the financial crisis in 08 and 09, it returned at the 50% level. Again, bonus deductions and 179 expenses are designed to spur investments and spur the economy. 2010 was the first time we had 100%. 2011, we had 100%. Then we dropped back to 50% level. We went back up to 100% after TCJA, but only through 2022. And now we're in the step down phases, 80% in 23, 60% 24, 40% 25, 20% in 26, and none in 2027. Well, that's the current rule, right? So we will wait to see to what extent these bonus percentages change by any tax legislation that begins to be first proposed and then working its way through the Congress during this year. This is where we are currently, and you can see it has fluctuated in prior years. We will see what the future holds for bonus deductions. Will they continue to decline? Might they reset at higher levels? We will wait and see how that works. One of the additional taxes that sole proprietor farmers incur is the self-employment tax. This might also be incurred if they're a partner in a partnership. And this tax is often asked by clients, what can I do to reduce my tax liability? I want to manage my tax liability to improve my overall net worth after tax. And what things impact self-employment tax obligations? And one of these is the new TCJA provisions. If I trade in machinery that can lower my tax liability under TCJA, that was not true before 2018. And it's true because the full value of the purchase is appreciated on Form 4562 and then moves to Schedule F, again for a sole proprietor individual. Partnership begins on 4562, goes to a K1, and then ends up on Schedule E, page 2 for those partners. The full purchase price can lower the SE tax. I do have to report the sale or the trade-in value at fair market value on Form 4797 as a sale of an asset. But items on Form 4797 are not subject to self-employment tax. So that gives us a chance to reduce this tax obligation. So here's an example. I have a truck that has a fair market value of $20,000. It's traded in for a new truck with a total cost of $45,000. The $20,000 trade-in is reported on Form 4797, which is not subject to the 15.3% self-employment tax. And the potential savings is about $3,000 compared to the rules we had pre-TCJA, which would be 2017 and before. Now the $45,000 deduction goes on Form 4562, then to my Schedule F, and I can choose again 179 deduction amounts up to $45,000. I can choose a 60% bonus deduction, or I can choose only the regular depreciation deduction. We'll see how that works in another example. So that sounds good, right? Sell my machinery and reduce my tax, but let's be aware of this caution that's very critical, especially in farm transition planning. Often the senior farmer who has a full line of equipment might decide to sell their equipment, and often thinking that if it's done by an installment sale, two things will occur. They'll pay tax over time and perhaps at least save the current tax amount, or maybe pay tax at lower rates. And maybe it's a favorable transaction for the buyer who can pay for this equipment instead of all at one lump sum. They can pay for it over time with the seller acting as the lender. Well, here's the caution because of depreciation rules. If this is done via an installment sale with a machinery transaction stretched over time, the full contract price is taxable in the year of sale, even if not fully paid for in that year. And I'll add another slight asterisk to that statement. The full contract price, at least to the extent of the depreciation that's been claimed in prior years, has to be recaptured in the year of sale, not the year of payment. So this is often an unexpected consequence of what's thought to be a favored tax treatment. Sell my machinery installment sale, collect payments over time, report taxable gain over time. To the extent we have to recalculate, or let me rephrase that, to the extent we have to recapture depreciation from prior years, that amount fully taxed in the year of sale, not in the year of payment. So that means a large tax liability occurs on a machinery installment sale in the year of sale. Doesn't matter when payments occur. If it's a related party buyer, another caution. That buyer gets no 179 deduction, does not get a used bonus. And now we know a related party buyer is not a brother, but it certainly is a parent. It certainly is a child. It's a descendant of that individual where related party rules come into play and cause reduced deductions to the buyer. A better idea may be to think about a long-term lease. And there are specific provisions, again, in Pub 225, the Farmer's Tax Guide, that describe the rules for a valid arrangement to be a lease. It's beyond our scope of study today, but it's there in Pub 225. And that long-term lease does, in fact, create income over time to the seller. And maybe it can be coupled with what I've called a periodic purchase option, which might allow the buyer to buy this piece or this piece in a year or two, but not the full price, and we've not committed to an installment contract over time. This can, in fact, stretch income over time without the 1 year full inclusion of income. Let's look at another example about a trade-in value of a tractor, and it's acquiring a new piece of equipment. How does it look? In this case, we're going to trade in a current piece of equipment. This is a tractor that's worth $85,000. It was acquired for $90,000, has been fully depreciated, so my remaining cost is $0. The purchase price of the replacement tractor is $185,000. So we see our net trade-in value is $100,000. That used to mean something in 2017 and before. Right now, it's irrelevant for tax purposes. It does have meaning to the taxpayer because that's the check they've got to write. That's the obligation they're incurring to upgrade this tractor. So what's the reporting? We report a gain of $85,000 on Form 4797. I'll show you how that works in the form section in a moment. The full purchase price can be eligible for depreciation on Form 4562 first, and whatever that total amount is, then moves to the Schedule F, where the final deduction is included, along with other farm expenses and income items. This transaction, because we're reporting the sale on Form 4797, saves about $13,000 in tax. 15%, 15.3% actually, of that $85,000 sale price. A couple of other things. The gain on the Form 4797 in this case is ordinary gain. It's ordinary gain because the fair market value of the trade-in is less than the purchase cost of that trade-in of the tractor that is being traded. So there is no capital gain in this transaction. If instead the trade-in value was $100,000, there would be $10,000 of capital gain because the trade-in value was $10,000 more than the original purchase price. Well, let's jump back to the ordinary gain scenario as this example depicts. Because it's ordinary gain, we also are eligible to take a qualified business income deduction on that $85,000 sale, which lowers the taxable income from $85,000. It drops it by $17,000, 20% of the sale price because of this qualified business income deduction. So the gain on the Form 4797 is not subject to self-employment tax, and it is eligible for the qualified business income deduction. Well, let's look at another detail about calculating depreciation for equipment purchased by a farm taxpayer. Let's just think about no trade here. This is a straight purchase of a used tractor for $100,000 in 2024. Simple, straight up, no trade activity occurring. We know that new farm equipment has a 5-year recovery period, and used farm equipment has a 7-year recovery period. Slight distinction in the terms of the years over which the deductions can be claimed. So, and this is a used piece of equipment, so we have a 7-year recovery period to consider. Because it's a 7-year recovery period, it's eligible for the 179 expense election. We could use up to $100,000 on this acquisition. We could use $1,000 or any number in between, as long as we meet the other allowed rules for the 179 deduction. That's my first decision. How much 179 expense am I claiming? The second decision, how much bonus depreciation am I claiming? And for 2024, that's a 60% allowed amount. So I could use $60,000 for bonus, assuming I use none of the 179 deduction. And if I use $60,000 for bonus, it means I get another $5,714 regular depreciation deduction. So I could get $65,714 between bonus and regular without claiming any 179 deduction. Here's our reminder, next year that's only a $40,000 deduction. I say next year meaning the next tax return filing season for 2025. And if I claim no 179, that should say, or bonus deduction, then my regular deduction is $14,286. So for this $100,000 purchase, lots of choices about how much depreciation to claim. At the minimum level, $14,286. If I chose to use bonus, I get to $65,714. And if I chose the expense election, all the way up to $100,000. And we can mix and match these three provisions as we like to get the desired tax deduction. Just remember, the amount that we claim in 2024 reduces the amount that's the amounts that are available in 2025, 26, 27, the remaining 7 years of that recovery period. So they aren't additional deductions, it's just accelerated deductions. Claim them now and forego the deduction in later years. Let's look at a second example, which is a machine shed acquisition. This is a $300,000 purchase, no trade-in again, placed into service. It has a 20-year recovery period. It's not eligible for the 179 expensing because it's a 20-year property. 179 deductions can only be used on property that has up to a 15-year recovery period. And I'm going to place this in service for this example in 2024. I get 60%. So I get a $180,000 bonus deduction. The remaining 40% is deducted over the 20-year normal maker's life, which is a $4,500 deduction. Next year, in 2025, that $300,000 purchase is only eligible for a bonus deduction of $120,000, the 40% limit. There'll be a little larger regular deduction in 2025, but overall a significant reduction in bonus deductions for 2025. And if I claim no bonus deduction, the depreciation amount will only be $11,250. So for a machine shed purchase in 2024, there's really only two options available. I can't use any of the 179, so that one's off the table. I can choose the 60% bonus, $180,000, or none of it. or I can choose the regular deduction of $11,250. So for a machine shed, any 20-year property, my choices are $184,500 deduction or an $11,250 deduction. Not much flexibility. It's one property in a 20-year recovery period. So it's a big deduction or a small deduction. Again, in Illinois, where I live, and most of the taxpayers I work with reside, the Illinois deduction is only one choice, $11,250 for 2024. Now I'll get more deductions in 2025 and forward. I'll get my full $300,000 cost recovered through a depreciation deduction, but on my Illinois return, that will take 20 years for that to occur. All right, now let's look at a larger purchase example and point out some really unintended consequences of this new rule, coupled with the reduction in bonus provisions. So here we have an example where they've purchased $4.3 million of new machinery in 2024. They traded in a large amount of items too, 3.1 million. And so we have a net cost of $1.2 million. And that's probably what the farmer anticipates his deductions might be, $1.2 million. That's not going to be the answer. It's going to be a very surprising, perhaps disappointing answer to the taxpayer. Notice how much we acquired, 4.3 million. That's over the purchase threshold. That's an important number to keep in mind. We have a large machinery trade-in that's been fully depreciated out. So all of that's going to be ordinary income on Form 4797. And the 1.2 million, again, means nothing for tax purposes. It only means that's the check I've got to write. That's the financing that's being incurred to make this deal happen. I get no 179 deduction because my purchases exceed that threshold. And that's the first bullet point of this problem. We're going to have a lot smaller deductions than we initially thought we might. What do we get for bonus? Well, of 4.3 million, I can use 60% of that, which is 2.58 million. The other 40% generates 344,000. So you can see I'm still under a $3 million deduction using bonus depreciation. In fact, it's 2.924 million. That's the deduction I can get. That's the maximum deduction I can get because there are too many dollars of assets placed into service over the 179 threshold. So these are my deductions, 2.9 million. Remember, I have this gain of 3.1 that has to be reported from my trade-in. And so in fact, instead of having a deduction, federal taxable income increases by $176,000. We've pointed out this result from these declining bonus deductions for large purchases for the last couple of years. And here we are. This is happening. When we had 100% bonus, this was not an issue. But now that we're limited to 60%, by trading in 4.3 million of equipment, acquiring 4.3 million of equipment, trading in 3.1 and having a net outlay of $1.2 million, we instead have a net increase to taxable income. We thought we'd have a decrease by 1.2 million. So what's the result? An additional, perhaps unexpected, increase in taxable income by $1,376,000. We thought we'd have a decrease of 1.2 million. Instead, we have an increase of 176,000. And in Illinois, it's not any fun here either. Look at this result. We have a net increase of $2,240,000 because we get zero bonus in Illinois, and we have a large gain to report of 3.1 million. we only get the regular depreciation from that $4 million deduction. And that $4.3 million purchase for new equipment is a 20% deduction. So here's how we arrive at the net increase to Illinois taxable income. Well, that would be the same in any other state that doesn't recognize any bonus provisions, but I know those rules vary. Every state has their own set of rules about how we handle bonus. So my point is, don't only look at the federal tax implications, understand the state implications for where your taxpayer is conducting business. Well, we'll close with looking at a couple of forms. Form 4797. This is used to report the sales of the assets. There's really three parts of Form 4797. You're looking on the screen at Part 1, sales of property used in a trade or business held for more than 1 year. This is where we would think we would begin to report sales of farm assets. This is different than an individual who sells stock in a Fortune 500 company. Those sales are not business property. Those sales begin on Form 8949 and end up on Schedule D. Well, some of the 4797 sales will end up on Schedule D too, perhaps. We'll see how that may work. You'll notice also line 1A is for sales regarding stocks or real estate. If you're reporting a sale of machinery on this Form 4797, line 1A will be blank because that machinery sale is not on either Form 1099B or 1099S. In fact, it's not reported on any 1099 form. So here's Part 1. But let's jump to Part 3. This is really the order you need to think about completing these forms in. And Part 3 is important because here we report gains from Section 1245 property, and that is what farm equipment is under. We've used accelerated depreciation under 1245 rules, and under the depreciation rules, and that means we have a Section 1245 piece of equipment that gets reported here. So here's my tractor from the earlier example. It had a sale price of $85,000. And really, remember, it really wasn't a sale, it was a trade-in, but it was the fair market value of the trade-in that's required to be reported as a sale. We have a cost of $90,000. It's been fully depreciated. There's no adjusted basis remaining on line 23. We have a gain of $85,000 on line 24. That's the amount of depreciation that's been allowed in prior years on line 25A. So that is the amount of our depreciation recapture that will be reported. This is where an installment sale would happen too. And we'd have a large amount of allowed depreciation from prior years. And that would indicate that we'd have ordinary income to be reported. Since we have ordinary income, we now move to Part 2 of the Form 4797. And that $85,000 gets reported on line 14 for this form. It's just carried from Part 3. It's also combined into other items on line 17. There's no other ordinary gains to report. And then also on line 18B. And you see that $85,000 is entered on Schedule 1, Part 1, line 4, which will be phrased as gains or losses from other assets. Let's move to the purchases of the assets, and where are those reported? We begin on Form 4562. The amounts on 1 through 3 are set by the taxpayer. Actually, 1 and 3 are set by the statute. 1.22 million is the maximum amount. 3,050,000 is the threshold amount for when we can begin to lose the 179 deduction. Item 2 is what happened in this taxpayer's case. They acquired $100,000 of equipment. Their cost was $100,000. We're choosing $100,000 as our elected cost. We're choosing $10,000 as our elected cost in column 6C. Also in column 8, $10,000. Line 9, which is smaller, the amount of cost we're electing or the dollar limitation. In our case, it's the cost we're electing. We don't have anything carried over from the prior year, 4562. I made up a random number for business income of 63,549. And really what that means is I can't claim any 179 deduction that's greater than this business income limit. If line 11 was 0, then line 12 would be 0, and line 13 would be $10,000. But in this case, I have enough business income. I can use the 179 deduction, and I can get that full $10,000 deducted. So once I take the 10,000 expense election, I have $90,000 remaining. And here I chose to use the special depreciation or bonus allowance of 60%. 90,000 at 60% gives me a $54,000 deduction on line 14. And now what goes on line 19B? I started with 100. I took 10,000 off for 179. I took 54,000 off for bonus, and I have $36,000 remaining. That goes under the 5-year, 200% declining balance, regular deduction, regular maker's appreciation for a $7,200 deduction. So this taxpayer has $10,000 from 179. They have $54,000 from the bonus and $7,200 from a regular depreciation under makers, which gives me a total on line 22 of $71,200. I could have taken perhaps the full 100,000, but I only chose 10 and have a $71,000 deduction here for this taxpayer. And once more, the important part is those 3 steps in that order. Choose your 179 amount, choose your bonus amount, and the remaining amount goes to regular deductions for makers. These are a few of the resources that were used in creating today's presentation. You can find these resource links at these websites that are published. You know, if you're preparing farmer tax returns and you're looking for ongoing information as you're working your way through those, pull up Pub 225, have that saved electronically printed on your desk, whatever format you like. It's a tremendous resource to help you navigate the 2024 tax filing season for our farm clients. If you have follow-up questions, here's how you can reach me. You can also reach any member of the National Farm Extension Income Tax Committee through the ruraltax.org website. And most of our states have members represented there. We'd be glad to hook you up with your local contact. All right, thanks for joining our webinar today, Sarah and Janet. I'll come back to you if we have questions we'd like to address.
We do. Okay, let's see. There's a number of questions in here about grants and like conservation. So I did want to flag for folks that we did a whole webinar on the tax treatment of grants and things like those conservation and cost share programs. But so folks can find that on farmers.gov and in our video queue and also the slides. But there were a few more questions that maybe you can answer with respect to that. Mostly about the timing of like the purchase. So like if you purchase a tractor in December and you get a 50% of the funds as a grant, how do you report that, and which value would you use for depreciation? The entire purchase price or just the money that you paid?
I see, Sarah. Yeah, good. And there's also in Pub 225, in the income section, there's a whole section that describes cost share payments, grant funding, things like that, those types of income and how they impact revenue reporting. So to the example that Sarah raised, if the purchase is funded by grant funding, you would reduce the basis, especially if the grant funding is directly tied to that acquisition. You would reduce the basis of your acquired property by the amount of the grant, and then depreciate the after grant cost of that asset. Is that enough on that one, do you think, Sarah? Is that clear enough
Yeah.
response to that one? So typically grants, if they're directly connected to the asset purchase, require the basis of the asset to be reduced. If the grant is not specifically related to that asset purchase, you can report the grant as additional Schedule F income and then reduce the full purchase price. But at some point, you're only going to get a net deduction for the after grant out-of-pocket costs. There's a question about land purchase in 23, planting in 2024. They won't produce anything until 2027. Is there depreciation on this property? This is a question that doesn't happen in Illinois very often, so I would refer us this questioner to our ruraltax.org website, where I know we discuss this concept, which is pre-productive costs. So when you're acquiring assets or investing in assets that are not either placed into service or generating revenue for some time later, there's a whole group of activities under the tax code under 263A, IRC 263A, that describe how to account and deduct for these expenditures. They're pre-productive costs that can be, choices can be made on how the deductions are claimed. And one of the choices that's made, if you choose that one, it gives you a reduced depreciation deduction on other assets. So approach this one cautiously, look more closely at pre-productive expenditures and how those are handled for depreciation purchases. And our ruraltax.org group can, I'm sure, has an article about that. Would it only be an income or profit if sold for more than purchased? That's a great question. It's capital gain income if it's sold for more than the purchase price. It could be ordinary income if it's sold for more than its adjusted basis. So meaning if I paid $15,000 for an item and I've depreciated $5,000 of that so far, my remaining cost is $10,000. And if my sell price is anything above $10,000, it's ordinary income taxable to the taxpayer. If it's sold for more than $15,000, the purchase price, well, that's also income, but it's also capital gain income taxed at lower rates. So you need to look at the purchase price. You also need to look at its remaining cost, because if that cost has already been recovered through depreciation, then all the sale price will be income. If you have a farming business that does not make 2/3 of your income, do you still pay taxes for that business, or do you not have to? Yes, that's another great question, because the 2/3 rule really only impacts the requirement to make estimated tax payments. Or better said, if your gross farming income is more than 2/3 of all of your gross income, you can forego making estimated tax payments and only make one of those a year, January, after the year has concluded. So the farming gross receipts test at 2/3 level is really only about making estimated tax payments and what those rules are. It's all taxable income, even if it's a small part of your overall taxable income to report. Good question. Thank you for clarifying that piece. My husband purchased a new tractor in 2023. I have a new business in 2024. can I claim the use of his tractor as a rental fee for my business? If so, what form do I use? Well, yes, that's certainly possible. If your business has a reasonable need to utilize that tractor, you can write your husband a rent check. That will be a deduction for you on your business, which I assume is maybe filed on a Schedule C as a rental expense. That's right, on Schedule C. Your husband then will claim that income on his Schedule C or F, depending on certain factors of how his rental arrangement really applies. If it's really just a small personal property item, it might get reported on Schedule 1 as other income. But irregardless of how that occurs, you as the payer will have a tax deduction, and the husband as a recipient will have taxable income. In addition, you would be required to send a 1099 MISC reporting those rental payments to the owner of the tractor. So yes, if the tractor is needed as a reasonable expense in your business, a rental expense is allowed. All right. Oh, Frank's confirming. We were just talking about the depreciation on the land. Yes, exactly right, Frank. Land can't be depreciated. I was thinking about the vineyards and the grapes and all those costs, but that's what I was referring to. There's a question about software. I don't think, I've not used software, all types of software. So I'm sure I'm not qualified to answer questions about specific software usefulness. But always okay to grab something and experiment. What if you're constructing a shed in December 24, but it's not in service by the end of 24? What about those costs? That's a great question. It happens frequently, caused by delays in getting materials, the contractor got too busy, or weather might have caused a problem. So in this case, we have assets that can be placed on a depreciation schedule for deducting when they're placed in service in 2025. So I usually report those costs on my depreciation schedule with a place in service date of 2025, and I take no deduction in 2024, but I'll have the full deduction in 2025. It just so happens the construction occurred over a year end, so we have a little bit of extra reporting to deal with. But if it's not placed in service, not ready in a state of readiness for its intended use, no deduction in 24, accumulate those costs and place the whole item in service in 2025. Does the cost of crop insurance covered by FSA and income? I'm not sure how FSA might report that, but the short answer is yes. If FSA is providing a cost reimbursement, then that's going to be income to the taxpayer. It could be reported on a Form 1099-G if it's actually a government program payment that's being covered. If it's actually a crop insurance indemnity payment provided by the crop insurance provider, then it will be reported on 1099 for crop insurance, 1099 miscellaneous. It's going to be on that 1099 form where crop insurance payments are reported on 1099 MISC. So it'll be reported if it's at least $600 on one of those two forms. Irregardless of how it's reported, it'll be treated as taxable income by the recipient. Can a greenhouse be depreciated? How should we report if part of it was paid for by a USDA grant? If the grant was specifically for the greenhouse construction, we would reduce the basis in the greenhouse by the amount of the grant and depreciate the remaining cost paid out of pocket. Greenhouses, oh gosh, I just lost my head about what those lives are, but I'm certain they are no longer than 20 years, so they can be certainly eligible for a bonus treatment as well as regular depreciation. Something tells me they are 15 or 10-year property. The reason that's important is then the net cost could be eligible for the 179 deduction. That will be identified both in Pub 225 as what the class life of a greenhouse is. It's also reported in form or in publication 946, which is the depreciation deduction, depreciation publication. And in the very back of Pub 946 are two tables, and they list very specific assets, and it will tell you this is the class life for that very specific asset. And if the asset isn't listed, it will say, well, if this asset is used in farming or horticulture, then it's going to qualify as this type of property. So I would first look at Pub 225. If that doesn't give enough detail, Pub 946, the depreciation publication, I'm sure has a specific class life for a greenhouse. All right, Sarah, that's the one. Oh, we have one more that just popped in. Should 1099G be reported on IRS 1040? It goes on Schedule F if the payments are related to an ag production enterprise. So it gets reported on schedule on the Form 1040. If the grant is related to, not an ag-specific ag production, not a trade or business of farming, then it gets reported on Schedule 1 as, I think on line 8 as other income. But anything that's related to the trade or business activity of farming, yes, Schedule F on the 1040. All right, Sarah, I think we're covered. Lots of great questions. A lot of people joining us today. It's been a pleasure to be a part of this webinar for USDA and our friends at Rural Tax. Sarah?
Yeah, thanks everyone. It looks like we cleared the queue, and just as a reminder, this is all going to be posted on farmers.gov/taxes. And thank you so much, Bob, for joining us today. This was very helpful and informative. And have a good afternoon, everyone.